I'm deferring on my seeds so I can pay taxes on the harvest. I don't know if I like that idea. Maybe if I paid taxes on my seeds, my harvest would be tax-free. So this example was just to show you how you can navigate through. So when you guys are thinking about the flow of your money, think about, do I have access and control of this money after I make this decision? If I put money into a securities account, how liquid is that? Pretty liquid, right? I mean, I could sell off my securities. What if we're March, April 2008, how liquid is that? Not really the best time, right? We covered that a little bit earlier. So even market-based securities are not liquid, potentially, when I need them. But guess what was on sale in 2008? Securities. So if you had money in a non-market correlating asset that you could access, you could clean up. Same thing with real estate in 2008, right? It was a killer. But it was also an awesome time to come in and sweep up from all the carnage from people that hadn't planned properly, right? So why I keep such a big chunk of my income going into that box is that box in 43 states is fully creditor protected, like I said. It's tax-free and liquid once the dollar goes in there. And once the dollar goes in there, I never pay a tax on it again unless I liquidate the account and cancel it. Then it's no longer life insurance, so then it's not afforded those special tax privileges. For the small business owner, it's one of the 12 strategies that Kelly didn't get to, but properly funded life insurance is used every day in the Fortune 500 world to the point where they have, in many cases, billions of dollars of it on their balance sheet. Bank of America has tens of billions of dollars in cash value life insurance on their balance sheet as some of their most prized tier 1 capital. So I'm spending a lot of time on that because this is one of the most maligned situations you can find. Like I said, try to find positive press on it. I believe the reason for that is there's 2,500 insurance companies in America, and there's 12 that manufacture a decent whole life policy. So why do you think we don't hear more about it? Because the vast majority is spending a lot of money on advertising to convince us it's a bad deal. But it used to only be mutual insurance. There used to be only one product if you wanted life insurance, it was whole life. Then term came along, then universal, then every other flavor of universal. All of those products have subsequently failed. But for 200 years, whole life policies have been paying dividends to policyholders. So when people ask me, what are the 1 or 2 things I can do with my money to improve my life? Buy a big whole life policy and fund it correctly. Not a universal life policy, not a term policy. That's one of the best things you can do. Whether it's from me or somebody else. Honestly, I think that's one of the greatest things you can do. Number 2, I think if you focus in on protection and you develop a good exit strategy, what I wanted to spend a little time on was, you could use one of your workbook pages for this if you want a blank page, but kind of going back full circle on this piece. If the savings and growth categories represent all my assets, right? So everything I've taken from my business balance sheet and I've moved to my personal balance sheet is going to ultimately reside in one of these places, either my savings type assets or my growth assets. So let's say I do proverbially kind of win the game and I end up with the 10 million or the 2 million or the 5 million or whatever your mark is for sufficiency. How do we get to that point, like Kelly was describing, the sufficiency number mechanically? If the number was 5 million, because that would produce enough income for the rest of your life, how do we turn this $5 million that might be in investment accounts or real estate or other places, how do we turn that into guaranteed income? An annuity. Okay, now is that a word that you hear a lot of great press about in the world? But every single pension plan in America that people love, that's the #1 key to retirement, is an annuity. It's not basically, it is an annuity purchased from a major insurance company. Kelly was being generous there, but banks don't offer annuities, corporations don't offer annuities. He was trying to be political. It's insurance companies that offer annuities. And some annuities are accumulation style annuities, and some of them are income style annuities. But I can take a client with $5 million that if we forced it into a Merrill Lynch account at 4% interest, would produce $200,000 before taxes for them. And I can take half of that money, $2.5 million, to not only replicate this income, but if we annuitize $2.5 million, and spent it down over your normal life expectancy, what happens if I lived to 96, but I was only supposed to live to 83 when he was talking about the actuarial science? What happens to my annuity payment in that situation? Anybody know? It stays the same.
Beating the bank.
I'm beating the bank. So what do they call all this area here where my principal's been paid down and this is all the extra? This is called mortality credits. I'm getting credit for other people's lower mortality, and I'm getting to take advantage of that. The only product that offers that is an annuity. Why do insurance companies win the game? Because they're playing both sides of the table. They're playing the life insurance side. Now, what do they want in a life insurance policy when they sell it to you?
Live forever.
Live forever, because they get to collect premiums forever, or for a long time.
The term policy.
Or die, that's even better. For selling term, then if you die that day right after is perfect for us. Because we don't care about you anymore, you're not a policyholder anymore. And you're off our liability list. So again, going back to kind of how it all organizes around this, if I'm playing both sides of the table and I've got the same goal as the insurance company, I want to live a long time too. So I'm not buying all that insurance because I hope I die early. I'm buying all that insurance because I want to protect if I do, but I also want to have it produce other opportunities for me. So when I get to retirement, if I wanted to take $2.5 million of my money and annuitize it, am I disinheriting my kids by doing that? Even if the income was only going to stop, let's say at my life or the end of my wife's life? Not if I have insurance backing it up. Life insurance creates permission through that accounts receivable concept to spend and enjoy more of your money. And when I spend principal of an asset that's already been taxed, how much taxes do I pay on that principal? 0, right? Put $100 in the bank, at the end of the year I cash it out for $101. I'm only paying taxes on the one.
Can you draw a picture of what you just described? You're talking about annuities, and you're talking about life insurance, and you're talking about
Can you use this one?
Yeah, sure. We're not trying to dry erase now. What was it? So describe the,
So do that again. You were talking about annuities, and you were talking about, am I stealing from my kids, basically, by buying this annuity, and then you said no, and then I just want to make sure that what you said after that is very clear mechanically how that works.
okay.
And why that's the case.
That's a great point. So let's look at 3 different types of accounts. I go in with $1 million to the bank, and I say, I'm 65 and I do want to retire. I want income from this. Or maybe I don't want to retire, I just want the income. How much income, if I buy a CD, am I going to get?
Today's rates.
Yeah,
0.25 basis points.
Yeah, $20,000.
let's say 2%. Yeah, 20 grand. Now, if I go using the capital at work model, the brokerage houses, the wire houses, what are they going to tell me is a safe withdrawal rate based on the Trinity study and all the things?
Double that, 40,000.
40,000. If I'm 65 years old and I go into with the same money to an insurance company, and I say, how much income on a guaranteed basis will $1 million buy me? The distribution rate is between 6 and 6.5%. So that same $1 million buys me 60K of income. Now, how is that possible that the same amount of capital at the same age buys such a different amount of income? Is this income guaranteed? Yeah, it is, because it's a CD. Is this income guaranteed?
No.
No. 15? Okay, cool. So when I buy the CD, I'm trading off return for what? Security. That's the only reason people buy CDs, in my opinion, because they're taxable investments. They're locked up and illiquid, even though you can get at the money, but then you forfeit the interest that you're earning, which is fairly meager. So now, if interest rates were 14% like they were in 1980, maybe all of a sudden that looks okay, but in an 18% inflation environment, I'm still losing money there. So my point is, the banks aren't very generous with what they pay you. Brokerage houses aren't very generous either, but they'll give you whatever the market will bear. Insurance companies base all their calculations not on the financial powers, which are rate of return and interest rates, things like that. They're basing it on actuarial, life expectancy, mortality rates, things like that. So again, you can win this game too by playing both sides of the table. Now, when they sell you a lifetime annuity, how do they win?
You die before it.
You die before you used all your own money, right? I put in $1 million, I got one check for 60 grand and I kicked the bucket because retirement wasn't all that we thought it was going to be and I died anyway, right? So in that case, in a non-refund annuity, the insurance company really made out like a bandit. So most people don't buy those anymore. They used to be the only kind of annuity that there was. So when these were the only kind of annuity that there was, can you see why annuities got some bad press from people dying early, right? Now, the same is true, though, if I happen to live beyond life expectancy, and I get way more than I should have gotten based on that. So as a consumer, I win if I live a long time with an annuity, an income annuity. As the insurance company, they win if you die early. But again, they don't really care because they price everything based on everybody dying right on time. So when we build a strategy for retirement, we can essentially have a $5 million estate spend like a $10 million estate. We can have a $2 million estate spend like a $4 million estate from a cash flow perspective because we're able to turn dollars that otherwise would have been in the market or somewhere else into an income flow. Now, we don't take your entire life savings and put it into an annuity typically. In the example I used with the $5 million, if I'm getting 6.5% or 6% on $2.5 million, and I kept my other $2.5 million liquid, let's talk about what life looks like for this person. Let's pretend that they have a $2.5 million whole life policy death benefit, which isn't going to cost $300,000 a year, and they have $2.5 million of assets that they're willing to annuitize, and then $2.5 million that they're not going to annuitize. So I'll do a fresh page for that. So you got the setup, right? We got $5 million of total capital. We're going to take $2.5 million and create a guaranteed income stream at 6%. That is $150,000 a year as a guaranteed paycheck as a joint and survivor annuity for me and my spouse for the rest of our life. It's not so bad, right? About $12,500 a month or so, guaranteed, like clockwork. Every month comes in the mailbox. There's no market risk, no nothing. Just imagine that you're currently not able to work or not working anymore by choice. Can you build a life around that from a budgetary standpoint? That's pretty cool, right? And what's even better is I still have the other $2.5 million that now if I'm going to be in the market, which I was at Merrill when they put me in the market generative or the income generative portfolio at 4% to produce 200 before taxes. By the way, since I'm annuitizing this, most of this money is after taxes, so it nets out about the same. I've now got this extra $2.5 million that could be invested long in the market. Do you guys know what that means with a different time horizon where it's more equities focused and less income focused? So it's not producing as much taxes. I'm getting rewarded for the amount of risk that I'm willing to take. Those types of decisions allow for me to truly be rewarded for the money that I have. And by the way, since this is fully liquid and what Kelly would call surplus assets, right? If I need an extra $100,000, is there any consequence to me taking it from that securities account? There isn't. But if I had my $5 million invested to produce my 200, and I pulled an extra 100 out of that, and now I only have 4.9 at the 4% rate, for the whole rest of my life, as long as I'm alive, my income has gone down. So up here, I have 150,000, which is about 95% or more tax-free as an income stream, guaranteed for life by contract as a promise-based asset. And I've got $2.5 million liquid. And even though this goes away when me and my wife die, because I've got insurance to cover that, my kids still end up with the $2.5 million of legacy that I wanted them to get.
Plus anything left in your investment.
Plus anything left in my investment account, which now if I have a 30 or 40-year investment horizon during retirement, if I got 4% only. Are you guys familiar with the rule of 72? Have you ever heard that before? Do you know how it works? So if we divide our rate of return by 72, that tells you how many years it takes to double your money, right? So what is that? So that's 4 and 3, so it's 18 years. Essentially, my $2.5 million doubles twice if I'm only getting 4% in the market during a 30-plus year retirement. So that means, I'm sorry,
We self-actualize.
during a
During
35-year self-actualization, right?
During those 30 to 40 years of self-actualization.
So what does that mean? I've now got $10 million in the market. I've got my $2.5 million of death benefit to recover the $2.5 million of annuity income stream. I've got all this guaranteed income. And what am I using? Where's the risk involved in this? The risk is here on money that I don't need to live. But what I had to do up front is I had to be willing to make the commitment that it's my personal responsibility that this stuff works out. Nobody is going to come down at the end, like in the Greek tragedies, and save me at the end with God's intervention kind of thing, just because we didn't work it out. So whatever the end means for you, whether it's self-actualization, retirement, starting your own business at some point and leaving your employer, the fact is that if you want to have financial independence, you have to take personal responsibility, but you also have to be informed with the rules. So in the back of the booklet that I gave you guys, I put some rules together that are rules that I learned as a way of thinking about your money. So what do you think rule number 1 is?
Buy whole life insurance.
It's partially. It's really full replacement value on everything. So if that means all I can afford is a bunch of term insurance, then buy a bunch of term insurance, because that's better than not having any insurance. I'm an advocate for whole life over time, but nobody in my client base starts with 100% of all the whole life they're ever going to want or need day one, typically. That doesn't mean we don't start them out with the proper amount of coverage. I want to buy enough coverage for every client on the life insurance side that if they died tomorrow, their paycheck would continue for their family. The same is true for disability insurance, though. That's not a throwaway. If you're in the medical profession, that's one of the highest incidents of claims anywhere. On your feet all day, you're dealing with people, it's a stressful job. I mean, it can be really hard. They have a huge claims experience, and they're one of the few groups in the marketplace that get the value of disability insurance because they see sick people all the time, and they see what it does to their lives. But how can you tell me that it's more important to put $500 a month into your mutual fund than to make sure that the income that's creating that $500 a month, isn't protected? Like, that just is an out of balance strategy. So I would say protect first, fully, and forever. That's the rule number 1.
So can I also offer one
Please.
testimonial? So Truth in Lending here, I don't work with Jason, I work with a different guy that I met before I even knew Jason.
Who's a colleague of mine now.
Colleague of his.
And
in the same
shares this
industry.
philosophy, by the way.
Absolutely. Unbelievable.
Great mentor for me, by the way, too. Just tell you that.
Nice.
So,
Let's just think about this simple thing. I don't remember which one I did it, but what we did was we raised the deductible on one of my other policies, whether it's homeowners or car, and the money I saved by raising the deductible fully funded a $2 million umbrella policy.
yep.
So I didn't even spend any more money, and I got fuller protection. I mean, that's the way these guys think. It's really,
So
kind
what?
of brilliant stuff. Yeah.
So thank you for that, and that's a great point. So this is typical what I see. People are at kind of minimum limits, or maybe they have a little bit more, 300, 500 on their home, no umbrella, right? And what's interesting is the premium dollars that they're spending here, meanwhile they're sitting on, let's say, $10,000 in their checking account. Is it going to kill me if I had to spend $1,000 on my deductible if I have a fender bender? As long as my car gets fixed, right? And if I'm going to report the claim, I'm probably not reporting a $522 claim because I don't care that much about the $22. And if it's my fault because I'm reporting the claim, then my premiums are going to go up, right? In most cases. So just by adjusting the deductibles, like you just mentioned, which is a common technique. So we start in P1, which is car insurance.
It's common for you guys. It was like totally uncommon thinking.
I'm saying it's a common technique if you're using this model.
Right.
If you're not using this model, this will be blind to you forever.
Absolutely.
If I raise my deductible to $2,500, is that going to kill me if I have a car accident? Of course not. But if I kill somebody else when I have that car accident, and it was my fault because I looked down to check a text, and now they're gone, and they happen to be a doctor making $1 million a year, what happens to everything else I've worked for 20 years, 30 years, whatever? It's gone. So just by adjusting this deductible, you save hundreds of dollars of premium. The most expensive thing on your itemized car insurance, I guarantee you, is your collision deductible. And by raising that, you don't save a lot of money, but a few $100s buys you a lot of umbrella coverage. Now, why would an insurance advisor not tell me about that? I don't sell car insurance. Partially that, but the more important thing is they get paid bonuses based on premiums collected versus claims paid. So how many $2 million umbrella policies do I want floating out there where people might have an accident or a problem versus not talking to them about that risk and just having them convinced that they can't afford to lose more than $500 out of their own pocket? The same premium, $2 million more of my wealth is protected, or 5 even in some cases, right? That's a simple strategy to fix problems. What about the disability drawer? This is expensive and I don't get any money back. What can I do to afford that? Well, if I stop compounding the interest on my mutual fund account, and instead I got rid of that tax compounding, that could be money that could flow up here to fund a disability program for me.
Say that again, what does that mean? Say that one more time.
So in your mutual funds, if they're non-qualified, meaning not in a retirement account, you get a tax bill based on a 1099 that you get for interest. That's dividends, interest, capital gains throughout the year. What most people do by default is they reinvest it, which increases the size of the account, but it also amplifies the tax burden, and they typically don't take the taxes out of that account. So if we look on one of these pages, I did an example of that just to show you guys something like that. So there's I think it's right after the action items report. It's called The Real World. If you can go in your booklet to that, I'll just give you a quick snippet on this. So this is somebody with $250,000 in their mutual fund account, which is a good number, by the way, right? That's a lot of money saved. That's earning 8%. And we're not even going to put it in a mutual fund. Let's say we're living in fantasy world and we move it up here to a CD. So not only is the 8% levelized, but it's guaranteed by contract. Would anybody invest in an 8% CD at their bank if there was one available?
Oh, yeah.
Right? Sign me up. Now, what would happen with the interest, though, is it would get reinvested. So let's say I liked it so much that I was going to move my $250,000 in mutual funds up to this CD, and I was going to add money to it, and I wanted to add 10 grand a year. Okay? What's interesting is if you go down where you look at it says the real world, you look at the 1099. So the moment I invest the $250 and I put another 10 in, my 1099 for that year is $20,000. So the tax due is $7,200. I'm putting in $10,000, thanks, and I got to pay $7,200 year one just to keep that account going. Now, do I pay it out of my CD interest? No. So guess what? This falls off the radar screen for people as a real cost of investing. The same is true down here in mutual funds or anywhere. Because we never pay the tax, we never net it out of our account. So we falsely attribute return to accounts that aren't returning as high as they are because we're paying the tax bill out of some other pocket at tax time. Now, if you don't have a model that's comprehensive to see all that happening, how can you possibly deduce that? What's interesting about the chart is by year 4, I'm paying more in tax service to this account to keep it going than the money I'm contributing. Now, how much sense does that make to you guys? That's compound interest. So along with the miracle of compound interest comes the curse of compound tax. And unless you're dealing with that, so what's an alternative? Well, if I shifted this money out, and instead of putting it there, I put it into municipal bonds, for example, I could buy a bunch of municipal bonds every year with the interest that I'm earning instead of letting it reinvest. And they produce tax-free income, at least from a federal standpoint. And maybe that's the money that I bring back up here to use to pay my whole life premium. So now I've got a triple tax-free loop. I'm using tax-free income from my municipal bonds to fund a tax-deferred asset, which forms cash value for me, which can be accessed tax-free. That's the trifecta right there. If you can put in tax-free money to build tax-free and to pull it out tax-free, where's the tax man get their due?
And I'm sorry, you just said something tax-free on the life insurance. It's only on the growth of the...
On all of it. Your principal. It's also the last first in, first out asset, life insurance. So that means that I can pull my principal out before I have to pull out any interest. I can't do that with a mutual fund. I can't do that with a piece of real estate. If I want to get my principal out, I have to liquidate it and pay all the taxes that are due, right? So that's just a quick example. I also put an example in here on the buy term and invest the difference conversation because I thought that might come up. Like I want to buy term insurance and invest in a piece of real estate that I think is going to yield 8%. Running through the numbers there, I just wanted you to see all those red columns there. They show the real cost of investing. So it's not to say it's bad. It's just to say that there's more to the story than what we're being told. And when we're focusing on one item, we're missing the bigger picture. So in this example, I'm using an 8% yield for 20 years without missing one. And ultimately, starting with the 250 and putting $10,000 a year in, that produces over 20 years $1.2 million. After I pay the embedded capital gains tax, which is that 9719 on the bottom there, deferred CG tax, I'm left with $1.1 million. Doesn't sound so bad. However, I also had to pay taxes, and I lost the opportunity on those tax dollars. So when you see tax and LOC, what that's showing you is not just the tax dollar that's flowing away from you, but all the earnings you could have made on that tax dollar. So the tax and LOC is $300,000 alone. So if I back out my initial $250 of starting principal from the $1.2 million, we'll call it, and I back out my $200,000 of contributions over 20 years, okay, that's taking $450 away, so I'm at $750. Then if I back out the cost of the taxes and LOCs, that's another $300. And by the way, I was paying for term insurance, which had its own cost and an opportunity cost on that. So the combination of those two is another $56,000. Oh, and by the way, the piece of real estate that I bought or the mutual fund that I bought also had a management fee of 1.5%, which I had to pay along the way. So that's another $200,000. So when I back out all the numbers, the 350, the 200, that's 550 minus the 750, we're left with about $200,000 of realized wealth on a guaranteed 8% investment for 20 years. Now that's reality. That's what's happening to our money. We need to get a handle on that if we want to win the game, because that's the stuff that's going to chew us up and spit us out the back end, and why 95% of the people aren't realizing their dreams. Because they didn't have the big liquidity event, they did everything everybody told them to do, and they still failed because they missed all these parts of the word problem. It's like in junior high when you had a math problem and it was like 3 paragraphs and you didn't want to read the whole thing, so you only read the first paragraph and you answered the question. You typically got that question wrong because the trick was always in that last sentence or two, or somewhere buried in terms of what the real question was. So you think you know what they're asking and you start answering it. That's what people are doing with their money. They're getting to that first layer deep. Oh, how much did your portfolios return last year? Okay, great, that sounds good, I'll do that. Or, what's the interest rate on that mortgage? Yeah, let's do that one. How cheap is that insurance policy? Okay. But they're not getting to the next 2 and 3 layers deep. And I think that's what having an awareness of velocity of money can do for you, is you can really start to produce multiple returns on the same dollar efficiently and safely and realize all your dreams. I've met people that say, I would never put money in life insurance because I want to buy real estate. How much real estate did I buy from owning life insurance? Like the life insurance companies bought it all for me. And my tenants have paid all the financing costs and repaid it all to the insurance company, not me. So literally a no money down program to buy a lot of real estate. So if you want to buy some real estate, you should buy some life insurance first. Buy real estate anytime you want. Life insurance, you have to be young and healthy.